the rand, 678, 679 this morning, so clawing back some of those losses from Monday when we traded above R6.90, and it looks like risk trade back on this morning.
Morning, Stephen. Yes, absolutely. After that global the sell-off on global equity markets on Monday, looks like sentiment has come back into the market. We had some better than expected data out of the US and Europe, and so on all fronts just looks like risk aversion is receding, and so we saw the rand benefit and strengthen on the back of that. Of course, there's also helped by a rally in commodity prices.
Well, we've seen that gold price hitting $1,500 an ounce last night, and it looks like it has more to go. So would you see more rand strength coming through with those commodity prices recovering?
At this point, yes, Stephen, if the rand manages to hold on to its gains today, then certainly we could see the rand strengthen in the short term.
We don't seem to have recovered quite as much as some of the other high-risk currencies, and I'm looking at some of the other EM currencies like the Turkish lira, but also the Aussie dollar and the Kiwi dollar. Why is our recovery lagging those?
Well, Stephen, that does seem to be a bit of a pattern with the rand. It always seems to have slightly more exaggerated movements. When emerging market currencies take a hit, then the rand is always, it seems to depreciate faster than the others and then recover slower when a recovery comes around.
Would this also suggest perhaps that we have the SARB still active in the currency market there?
That could be one conclusion you could draw, Stephen, but they have the Treasury and SARB have indicated that they continue to accumulate reserves, so it would be difficult to look at one moment and try and attribute that to Treasury actions. They've indicated that they accumulate reserves whenever possible, and one would imagine that that would be fairly consistent and constant over the months.
We have some important data out in South Africa today. We have the CPI, that's the March reading, and we also have retail sales, the February reading. CPI, February 3.7%. What's your expectation for that March CPI number?
Stephen, we see that ticking up to 4% year-on-year in March. That's partly because March is a high survey month generally, but also we could see the impact of some of the duties and levies that were announced in the February budget speech also reflected in the March number. So there's a lot of upside risk to that forecast, but we definitely see it accelerating in March.
Would you expect the core CPI number to remain relatively tame though?
Well, that would be what we'd hope to see. At this point, the main drivers of inflation have been food and energy prices. So once you strip those out, you would expect to see or hope to see that core inflation remains moderate. However, as I indicated, there are quite a lot of increases, annual increases, as well as things announced in the budget that could affect this number, and that could affect the overall inflation rate as well as the core inflation rate.
And do you think we could see a rand reaction if that inflation reading comes in higher than the market's looking for?
That's what we would expect to see happen, Stephen. If the inflation rate comes in higher than expected, that would of course have a knock-on effect on market interest rate expectations. You'd either see a scaling up of interest rate expectations to reflect more interest rate increases, or you could see people adjusting the expectations to have the Reserve Bank start to increase rates earlier than expected. So on that basis, we would expect to see the rand perhaps strengthen, and that would be on a yield differential basis.
Okay, retail sales, January's reading 6.4%, and we saw a nice improvement in retail sales coming through in the second half of last year into January. Would you expect that to have continued into February and beyond?
Well, as far as the first quarter of this year goes, we actually saw a dip in consumer confidence. So the dip that happened in retail sales in January was down to, it eased to 6.4% in January from 8.3% in December. So that was in line with a bit of moderation in consumer confidence. On a year-on-year basis, we are expecting an acceleration in February sales to 7%. But as far as the first quarter as a whole, although we're expecting still robust growth in retail sales, it is not likely to match the levels that we saw in quarter four if the consumer confidence readings are anything to go by.